for based in Rabat, Morocco, and I will be your moderator today. I hope that you will enjoy the next 60 minutes of conversation. We are going to be talking about investment in green infrastructure, or more precisely, how can the private sector pave the way for such investment? As you know, it is now established that investing in infrastructure is considered as a driver for economic growth. It acts through different channels, either in the short term by creating new jobs, for instance, or in the long run through the creation, through driving up potential growth and facilitating regional integration. Furthermore, the current crisis of the COVID-19 and as well as the climate risks that the world is facing are now calling for a new approach to infrastructure based on objectives of sustainability. So to tackle these issues, I am delighted to be surrounded by a very distinguished panel whom we'll have in the next 60 minutes, what I hope will be a very robust discussion. So I am very pleased to introduce first Dr. Shamshad Akhtar, former Minister of Finance and Governor of the Central Bank of Pakistan, Ottaviano Canuto, Senior Fellow at the Policy Center for the New South and non-resident fellow at Brookings Institute. We have also with us Franco Pasacantando, Scientific Advisor at the Instituto Affari Internazionali. And last but not least, Miguel Vázquez Martinez, Senior Affiliate at SDA School of Management of Bocconi University. So each speaker will have up to 10 minutes to intervene in order to allow time for discussion at the end. And I remind our audience watching us that they can at any time write to us their questions either via YouTube, Facebook, or Twitter, and we will forward those to our speakers. So without any further ado, I invite Dr. Shamshad Akhtar to take the floor. So given your rich experience both in the public sector and in international institutions, can you shed some light on the issue of scaling up investment in green infrastructure, particularly in the case of developing countries?
Okay, well, thank you for inviting me, and I'm very happy to meet up with some of the panelists here, and some of them are friends. So thanks for inviting me. I think whether it's green or it's climate friendly or climate resilient infrastructure, to me, it's all interrelated. Now, whether it is melting glaciers of Arctic or Himalayan mountains, and I am sitting very close to Himalayan mountains, climate change, as we know, is at an irreversible tipping point. Scientific evidence is on rising temperatures, sea levels rise, and disasters is now unfolding every day with severity. COP26, which is on the heels, offers us an opportunity to reinforce international agreements and commitments to ensure we reach net zero emission, green our planet, to protect and conserve our nature and biodiversity. Global finance and role of private finance, of course, will be very critical for course correction now. So investment action has to recognize what is the source of the problem and what is its scale. As I graphically mentioned, that every day we are seeing climate change at play. But if you zero in, 60% of the greenhouse gas emissions are from infrastructure, 80% from urban areas. Ecosystem degradation, as the evidence from one of the T20 papers indicate, is close to about 4 to 20 trillion per year, lost largely from land cover changes, and there is another 6 to 11 trillion from land degradation. More than 70% of wildlife declined since 1970s, and all key forests are impacted by fire or other hazards. So there will be no one-size-fits-all solution to investment in greening or climate resilience or sustainable infrastructure. We would have to adopt multi-pronged approaches and look at also the country context. We have to factor in climate risks now, and the good news is that there are several platforms which are allowing for understanding how to go about stress testing. And more recently, in the IMF Comprehensive Surveillance System, we will have climate risks factored in. And this will help the diagnosis. It'll guide businesses on what to invest or not to invest in, how to strategize green investments, how to deploy and which sustainable technologies and solutions to adopt, and how to go about mobilizing sustainable finance to develop climate resilient and green infrastructure to support climate adaptation and mitigation projects. Rather than focus on shovel-ready infrastructure projects, emphasis has to be, of course, promoting green, sustainable, resilient, and inclusive infrastructure. Global cooperation and whole of the government approach that cascades climate neutrality ambition and action from national to the city to local government level is critical to strengthen infra resilience and sustainability. Within this context, the moving forward direction has to be to leverage private sector, which is critical not only for finance, but also for the expertise. But like everything else, we have to get the incentives right for finance, technology, management, and financial innovations. Now, there are plenty of opportunity to build back better, with focus on, of course, new growth, sustainable opportunities. Momentum is growing as countries have stepped up ambition and goals, and nations are juxtaposing economics through construction, optimization, and reduced life cycle cost, and reinforcing it with environment, social, and governance and institutional sustainability to lower the carbon footprint. 110 countries have pledged carbon neutrality by 2050 to 2060. 50% of global GDP, hence, is committed to it, representing half of global carbon emissions. Energy-related emissions, of course, account for 60 to 70%, while remaining 30 to 40% come from non-energy related sources. So what is in store? First, there has to be a shift from fuel-intensive assets to renewables that offer cheaper power. Its expansion is forecasted to create anywhere from 165 to 605 billion by 2030. For every $1 invested in green and sustainable infrastructure, there will be 3.7 injected in the economy. And here is the economics. Sustainable construction methods and materials and efficient supply chain opportunities are emerging and would lower production and user costs, with, for instance, green cement expected to grow by 15% over the coming decade. Size of energy efficiency market in 2030 could be over $1 trillion, supporting conservation and efficiency. Low carbon transport through electrical vehicles and charging infrastructure, greenways for cyclists, smart ports, and efficiencies, including mobility as service platforms, and the BRTs and the LRTs will double investment in the range of 310 to 320 billion and create 15 million jobs. Digital corridors and technology are enhancing efficiency of connectivity infrastructure, and smart cities through broadband, fiber optics, and internet for all, etc., would generate about 17 trillion economic savings by 2050. So momentum is being built. There are opportunities for private sector, whether it's in hardcore energy or effective waste management, water supply. It's all out there for the private sector to grab it and go for it. My second point, moving from the greenhouse gas emissions dimension and zeroing in on the sectors, my second point is that there are, of course, several global and regional initiatives at work to enhance innovation. Some are trying to work on policy, regulatory, and transmission frameworks, including variable renewable energy. And of course, there are precedents for many and off-grid solutions. There is, however, still need to work more on public-private partnerships. There are a number of countries that have good institutions, that have regulatory frameworks, but it's not as yet fully ingrained across the developing or emerging markets as yet. There's need to, of course, extend corporate public-private partnership agreements. We have to work on carbon renewable trading frameworks that could be enhanced through tax incentives for green finance behaviors, and reposition sectors and businesses that are more vulnerable to climate disruption. Furthermore, governments are working on SDG 7 of the United Nations that envisions access to affordable, reliable, sustainable, and modern energy for all. Carbon tax and pricing is being adopted on a very selective basis that could expand and would be very helpful. The global supply chain offers also ample opportunities to encourage companies to follow the global trend, particularly the Renewable Energy 100 Companies initiative could be scaled going forward. My third point is that there is need for enhancing accessibility to global green and climate finance by inducing more scaling and predictability and flexibility to support multidimensional strategy, to fund energy transition in a more systematic manner, to fund industrial and agriculture diversification, and to fund smart cities. Now, there's a lot that's out there, but at a country level, resources are quite limited. So the role of global finance would be very helpful. The deployment of the stimulus packages, be it targeted fiscal spending, monetary or tax incentives, ought to have enabled and reinforced the green recovery, but it's been rather slow in a number of jurisdictions because they have been trying to fight COVID-19. Some countries have successfully established dedicated green funds and green banks to facilitate right and smooth access to finance and advice for green projects. Infrastructure investment ought to be, of course, conditional on alignment with sustainability recommendations and shift towards low carbon pathways. So who's going to monitor all this at a country level? It's a lot kind of fragmented moving forward. In some cases, you have climate ministries. In some cases, you have environment ministries. But except when people are going to UNFCCC meetings or COP, my own assessment, having worked in a number of countries, has been that it's not, countries are not able to have effective coordination or institutional coordination. But my last point is that, of course, work is underway to implement carbon neutrality. But the efforts at the subnational government levels are very fragmented. Compared to national timelines of carbon neutrality, major cities, of course, have announced their own accelerated timelines of carbon neutrality. So there's C40 and C100 or whatever initiatives. But it's often unclear on how to act, what engineering and technological solutions to deploy, how to measure their impact and ensure results. It's all private sector driven in some cases, or it's driven by the municipalities. Requirements for climate resilient infrastructure are beyond developing countries' financing strengths, as their own revenue and balance sheets are extremely weak at the city level or even below at the local government finance level. They lack knowledge of new engineering designs. Some countries which empower subnational governments to raise financing lack the subnational fiscal prudence and end up over leveraging their weak balance sheets and or face defaults. Ottavanio had a very good paper some years back on subnational governments leveraging and the risks associated with it. Now we know that ratings currently, both of the countries and the subnational governments are not exactly very rosy. So adapting local infrastructure and regulating industries towards low carbon economy underscores, besides global finance, the need for harnessing domestic resource mobilization. So to conclude, what lends me hope is the initiatives where I believe that the private finance will get it right, is initiatives like the NGFS, the network of the greening group of the central banks. It's a very effective collaborative platform, and central banks have somehow agreed on the policy instruments and tools. There's no standardization as yet, and by virtue of their regulatory writ and the micro and the macro prudential frameworks and the old-fashioned credit ceilings and stuff like that, or for that matter, managing through monetary policy instruments and disclosure instituting disclosure requirements, there is a lot of hope that we can promote the right finance, and that will involve the green finance as long as we allow for appropriate risk weights for recognizing what is green finances versus what is brown financing. And there is a recognition that central banks are considering the wrong financing as a financial stability risk. And as we move forward, there's also hope in the capital markets and institutional investors' side. Capital markets are fast transforming them into sustainable stock exchanges, and the institutional investors are being driven by the ESG finance. Just my last disclosure is that I'm currently the chair of the Pakistan Stock Exchange, and we are now launching efforts to in Pakistan to move towards establishment of sustainable stock exchange, and we are now developing ESG financing scores and encouraging companies to move forward so that they can attract long-term ESG financing. I'll stop here.
Thank you very much, Dr. Shamshad, for your brilliant intervention. We have noted the importance of working more towards public-private partnerships, reinforcing institutions and regulatory framework, implementing carbon framework pricing, and last but not least, as you mentioned, adapting local infrastructure to the shift that is happening right now towards low carbon economies. Now turning to Ottaviano Canuto, you have also an extensive experience both at the World Bank and IMF, and you have worked a lot on this topic. So in your opinion, how can the private sector play an active role in fostering investment in green infrastructure, particularly given the current context of the pandemic?
Thank you, Rim, for having me here, and also to have the chance to meet again these friends and ex-colleagues. I had the privilege of being a vice president at the World Bank when Shamshad was also a vice president. And I had the chance to be at the board of executive directors at the World Bank right after Franco Pasacantando gave his contribution. Shamshad Akhtar's presentation will make my life easier, as she was very comprehensive. But let me, let's say, benefit a bit from an ongoing work by some colleagues at the Policy Center in conjunction with the SDA School of Management through Miguel Vasquez, who's also here, on a note that we have been preparing on investment in green infrastructure in Africa for the T20. So let me at the outset establish what one might call three prongs to analyze the role of the private sector and what the public sector should do to help it to foster green infrastructure investment. But first prong, the investment needs, which are huge, and they are shifting increasingly to the side of emerging markets and developing economies. So the first prong of my argument is dire needs of lifting investments in infrastructure in developing countries, in non-advanced economies. And if we want them to decarbonize their economies, if we want them to have infrastructure that is resilient to climate change and also help them economize on being low carbon, we have to take this into account. Huge investment needs. Second stylized fact is the tightness of fiscal space in developing countries. Of course, the fiscal situation varies substantially. On the one extreme of the highly indebted sub-Saharan African countries, for instance, the debt restructuring will be necessary and so on. But the fact of the matter is that the situation that was not easy in many cases became worse, of course, after the pandemic, as the pandemic induced a sharp buildup in government debt, given the fiscal package and so on. And this is reflected in the rise of the government interest expenses in emerging markets, and that applies to developing countries as well. And the third prong of my argument is this trend of a decline in long-term real interest rates in global financial markets. That, as you can see, this chart was it has the U.S. interest rate, but if you look at the whole set of advanced economies, you will find a similar trajectory. So there is abundant money searching for yield, and this trend is not bound to change even with the pandemic and everything that happens. So the three prongs of my argument leave us into this set of observations. First of all, tightness of fiscal space relative to investment needs. Second, this paradox, this mismatch between the availability of low-cost finance and the scarcity of infrastructure investments, which leads us to the inevitable conclusion that we need to find ways to use the tight fiscal space to crowd in private investments in infrastructure, rather than trying to try to be in lieu of the private investment in infrastructure. So, but where lies the major challenge? The problem is that, and that explains the mismatch between low-cost finance available and the scarcity of private sector investments in infrastructure relative to needs, is that, it's the complexity of infrastructure projects that along the value chain of infrastructure projects, you have different types of risks. And there is not necessarily comfort by the private sector in dealing with some of them. If you open any typical infrastructure investment, you will see there the scope, the space for the participation of banks lending short-term money, particularly in the construction time. But you will also need the space for, you also see the space for once the investment is mature and is operating, you have the opportunity to finance it with bonds, and including institutional investors. You have the space there in the value chain of the investment projects also for risk insurers and so on. But the problem is that, given the lack of comfort in private agents in dealing with some of those risks, which are high in the case of infrastructure, and including the green infrastructure investments, then the way to crowd in private investments should be, or could be, the use of the tight fiscal space available to cover some of those risks, to provide some bridges. And that may lead to, and once you fill the void, a specific briquette that is missing there, you make possible the participation of the private sector in everything else. So the way to combine the three prongs and lift the private sector investment must be this risk-focused kind of public sector intervention. But also, we need to have more homogeneous project standards, and we have to have regulatory frameworks among the countries that are compatible. The reason I'm saying this is because all research with institutional investors, for instance, point out that they complain about the non-existence of pipelines big enough of opportunities to invest in infrastructure to lead them to invest themselves in creating the expertise and making building their pipeline in those projects. So we need to have some sort of a harmonization of standards and the fine-tuning of regulatory frameworks in order to provide a scale to the investments in infrastructure in emerging markets and developing economies as an asset class. That's something important. And of course, the green infrastructure investments will constitute special pipelines in this, in the sense that they will add a layer of requirements and definitions in order to become available. Shanshad made a very important point about the relevance of having standards to define what is green investment. And the work done by the NGFS, so many of us are counting on it as a way to pave the way for some harmonization of definitions of what are green infrastructure investments, so as to be able to accrue a premium from the markets, as it is typical of the green bonds. Just to finalize, let me illustrate what I mean by focusing the fiscal space into crowding in private investments. Instead of bulk financing by the public sector, the governments can provide specific point interventions that exactly address the mismatch between risk management ability and the profiles of the projects, so as to make possible the whole building. And I'm just listing there some kind of those instruments on the financial side and also on the revenue enhancing instruments. I used, and we had already last year provided a note to the T20, the Policy Center and and Bocconi, and also take the chance to make a propaganda of my latest book that has a chapter dedicated to the mismatch between finance and infrastructure. Thank you.
Thank you very much, Ottaviano, for your very enriching presentation. And what I took away from it was this paradox of the availability of low-cost finance and at the same time scarcity of infrastructure investments in developing countries. And the way to get out of it was to take advantage of or use this tightness of fiscal space to cover some of the risks for the private sector. And just like Dr. Shamshad Shamshad, you also mentioned or highlighted the importance of having a clear and sound regulatory framework. Now moving on to Franco Pasacantando. Drawing from your experience as a scientific advisor at the EIE and as a former member of the boards of the World Bank and European Investment Bank, why should we invest in green infrastructure, and what are the challenges facing private investors in financing local green infrastructure? Yes.
Yes, I was in mute. Yes. No, thank you, Rim. Thank you. I jumped on the second part of your question because I think that the first question that you raised, why we should invest in green finance, has been now very well covered, especially by Dr. Shamstar. I mean, it is clearly that the climate agenda is crucial. There is a top priority for the world as a whole. The issue is how we should concentrate the efforts of these investments and how we should support this type of investment. And I will also start with a little bit of propaganda, not on a book, but on an initiative that Istituto Affari Internazionali, for which I'm a scientific advisor, has been taken together with the Italian Finance Ministry for the G20 of this year, which is hosted by Italy. And so we suggested, and we have been working with the Italian Ministry of Finance to concentrate our attention on local infrastructure. You know, there has been many issues addressed by former G20s on quality infrastructure, big infrastructure, how to finance. We thought that by focusing on local infrastructure, we have a new, different, and very important perspective. And what has been said so far, in a way, confirms this. As it was indicated in the concept note that has been circulated, you know, almost 70% of, if not more, of the greenhouse gases are produced within cities. And what is striking is that the cities are sometimes the least apt to tackle these issues. We have been working also with the European Investment Bank in preparation of this conference that will take place in September for the G20 in Italy. And they found through a survey that 70% of European municipalities are not green. 70%. Of course, this is Europe. I hope somewhere else is better. But it tells you that there is a real gap. As well, also 44% are not digital. So the attention of municipalities, while at the government level and at the international community level, now the emphasis on climate and importance of green infrastructure is high. At the municipal level, the situation is very, very uneven. And so there is a lot of work to do and a lot of gains to achieve, to make by working at the local level. So what are the problems, the challenges that local authorities and local private sector face in addressing these issues, in addressing these needs, huge needs of infrastructure? First of all, as Ottaviano mentioned, in most countries, we have had a decreasing public infrastructure investment because of the pandemic crisis. Governments have been experiencing a fall in tax revenues and an increase in social expenditures. And this has been particularly true at the municipal level, because not only at the government level, but also at the municipal level. Cities are facing reductions in municipal budgets of between 55 and 40% in current financial year. Some estimates of the World Bank say that the contraction is about 60% in countries including Romania, India, and Romania. So much less public finance to support public investment. Now, as we have been all discussing, can the private sector fill the gap? And certainly, we have to count on the private sector to cope with and to compensate the fall in the government infrastructure. But that is not as easy as is said, because if there is a fall in municipal finances, in government municipal finances, also the private sector falls. So they do not compensate each other. They go to a certain extent hand in hand. To support the private sector, you need also strong public finance at the local level. Deterioration of municipal rating reduce the capacity of the private sector to raise funds and to invest. Plus, with municipalities that are short of funds, they can also have difficulty in attracting those expertise that are needed for this type of project. So, unfortunately, it's not that easy to fill the gap by relying on the private sector when also the public sector is seeing its financing deteriorate. Of course, the private sector still can do a lot, and also the local municipality can do a lot, even periods of difficult financial strategy. Well, we all know that to attract private sector, you need to have a strong regulatory environment, investors particularly look at long-term returns, so they don't like to have municipalities that change the rules of the game too often. So, in this moment, if municipalities concentrate on a stable long-term regulatory environment, they can do a lot to further encourage the private sector when financial conditions will improve. Somebody has already mentioned the issue of viable projects. All too often, there are not enough viable projects. And so you can use this moment in which maybe there is difficulty in launching new financial initiatives, but at least to create a good pipeline of investable projects that are environmentally sustainable. And the private sector, once they see that there is this pipeline, they usually find a way of addressing. Of course, institutional capacity and leadership is important. A clear distinction of the rules of the game, who does what. Very often in all our countries, in all our municipalities, there's a lot of confusion about who is responsible and who is the last, the leader of all the initiatives. And finally, to develop a climate finance strategy for both mitigation and adaptation. An infrastructure plan which has long-term support for politicians will certainly help. So those are all things that are important, I think. And even though I don't think they will provide an immediate relief, they are something that has to be done anyway. Now, of course, an important aspect is to improve the framework for implementing private PPP projects. As the economy is deteriorating, has been deteriorating, also the risk assessment of private investors has been deteriorated. So private investors, even though there is a lot of availability of funds, Ottaviano, you are quite right. Unfortunately, the uncertainties about the future that fortunately now seems to be less pronounced, but the uncertainty on the futures has really held down private investors, not only in infrastructure, but overall. So it is important a PPP usually is a mechanism to shift risk to the private sector. Now, in this situation, in this particular situation, it is important that the public sector continues to retain an important part of this risk, because the private sector by itself will consider too risky to undertake PPP projects. So there are ways for the public sector to have a greater role in equity, greater role in junior debt, grants, so that they shift now. They have a better balance of risk between the private and the public sector, because the private by itself now in this very risky environment will definitely suffer. And also one should think that there's a lot of talk about PPP, but let's also look at other instruments. Again, the crisis has shown, at least in Europe, which I know better, a lot of programs of guarantees to support small firms and medium-sized firms that have worked rather well. So, PPP, if you see the record also in advanced economies, is always difficult. I mean, sometimes they have not yet recovered the level before the Great Recession. While other instruments are being improved, are being shown as very important to attract the private sector. So it's important to shift also the attention on a broader set of instruments, especially on loan guarantees, which are working rather well. Now, the role of global finance, as Dr. Shamshar has mentioned, there is clear a role. I mean, now, especially for developing countries, given the difficult budget conditions, international finance can provide a great role. Now, here there is an issue, I think, what Adriana has mentioned, also of harmonization. And, if you look at, and I've been in preparing for this seminar, I've been looking at what the African development banks, and there is a list of quite a great number of climate change funds, green banks, local development agencies, African Development Bank, European Investment Bank, European Bank for Reconstruction and Development, World Bank, Chinese funding. So there is a lot of funding. Now, my impression, and I've had the experience of working at the European, for the European Council on reforming the European financial architecture for development, because in Europe we have the European Investment Bank and the European Bank for Reconstruction of Development, and they are starting to work in Africa. Now, my impression is that the coordination, if we wait that the coordination comes from the top, we will never get there, because these institutions are well established. It's very difficult to find agreement on the division of labor. So it's very important at the national level to create platform and to have leadership in coordinating the work of all these institutions. If this is done properly, it can be a great source of funding and can provide the rich opportunities of funding. So that is my last comment. So overall, we are in a difficult situation, but at the same time, there are new opportunities. There have been a number of new initiatives that have been taken. I think it's very important that this attention at local level, at the importance of green infrastructure be kept. And I'm happy that also the G20 now is paying a lot of attention. I heard that the T20 is also doing it. So I thank the YAI and the Policy Center for the New South for having brought the attention on this point. And I think I would like to conclude with some hope that this will, really open the future for new types of attention of the global community. Thank you.
Thank you very much, Franco, for your insightful presentation. You, of course, highlighted the need to focus attention on local infrastructure because there are a lot of gains to be achieved from that, and also the fact that the public sector should continue to retain part of the risks within the PPP framework. Now, last but definitely not least, I am turning to Miguel Vázquez Martinez. So given your experience from academia and as a consultant, what is your take on the role of the public and private sector in financing green infrastructures?
Yeah, thanks a lot, Dream, for having me here. It's super easy to speak after all these three great person. Very difficult to add much to what has been said. So maybe what we can do, or an interpretation we can make of the presentation I'm going to do, is kind of let's say summary of some main ideas that the previous presenters made, and I think because probably I'm not adding many great ideas that were not there before, but what I would like to let's say try to make clear are main steps, let's say, to implement many of the decisions that need to be taken in the near future. I think it's true that we're going to need green finance. We were going to need green infrastructure, which is going to need financing, and financing infrastructure and financing new infrastructure is always difficult. So I would like to almost begin with looking at the one of the things that Franco said about participation of the public sector, instead of trying to understand how the public sector can get in, trying to switch or to put the focus a bit more in this idea that also Taviano put forward, was this idea of crowding in. And in that sense, for me, in this idea of definition of risks and what can we do to help the private sector in dealing with risks, I think this idea of crowding in is important, and it's important to define, to understand that the objectives need to be clear, and basically, as Shamshad was saying, we need the standards definitions as global as possible, so that we can let's say define or list the risks that green financing or green infrastructure is facing, so we can let's say share roles, of course, as Franco was saying, not necessarily with PPPs, but with the ecosystem that Ottaviano was presenting. No? I would like to say that for me, and this is something that is very difficult to start agreeing when you come from different regions. It's what you're talking in Africa is many times different from what you're talking in Latin America or Europe. I would say we need to establish very basic objectives, and a bit more concrete than we need green infrastructure. What is the role of the public sector in financing the green infrastructure we're going to need? And there's the let's say the old-fashioned one that is still present in many places, and maybe probably Ottaviano discusses this way better than me in the book. So I don't have anything to promote, so I'm promoting Ottaviano's book. But there's this potential objective, more traditional one, which is the subsidization of structuring projects. This idea of the public sector needs to finance big initial projects that at some point they're going to end up in more developed sectors. I'm not saying, I'm not giving opinion here. I'm just saying that the financial sophistication required for this is relatively low, in the sense that, okay, if what the green financing requires is the subsidization of structuring projects, the solution is public intervention to provide the subsidy. So in this sense, I see a less potential for the private sector. We have, of course, the difficulty that Ottaviano put very clearly, that maybe we don't have enough money to do that. The second objective, or the second potential objective, would be to replace the private debt market by basically infrastructure, and green infrastructure is going to need, or at least right now is using extensively the debt market in jurisdictions where this debt market is more complicated. Maybe the public sector may replace the market and help developing this the infrastructure we require. In this case, again, not saying whether it's better or not, the implementation would be that the public sector is in charge of long-term financing of the infrastructure, and the private sector takes the risks in the short term, consequently the financing. The third one, which is, in my view, more it's closer to this idea of PPPs, is that the role of the private sector is to try and facilitate the evolution of the market, in the sense that they're not replacing the private sector. They just, as Franco said, going hand in hand with the private sector, and especially in jurisdictions where capital markets are not so thriving, try to help and develop, try to give an inertia that creates the possibility that private markets become deeper in the future. So in that sense, the third objective, which is a bit different from the other two, is more to eliminate barriers for the private sector financing than to really substituting or helping, or in that sense complementing the private sector. I think, for me at least, this third objective goes more in line with what Ottaviano was mentioning, or was explaining about closing the gap. What we don't want to fill the gap, we want to close the gap between potential relevant international finance and the local, let's say, possibility to use it. I think this is more or less the same as the slide that Ottaviano presented. What I wanted to let's say summarize here is that also Franco was commenting on this. what the public sector might do in the future in terms of green financing is a change of role, and let's say looking at the picture of um, private financing for the long term, and seeing what in that, let's say, big picture the public sector can do. And in that sense, there's, as Franco mentioned already, there's a huge role for credit enhancement, and there's also a role for revenue enhancement in terms of regulation, in terms of better market design for green finance. And I think that was it. Just mentioning a joke with Ottaviano. I'm Spanish, but I don't know in what language I speak right now. So I said obrigado. Then he mentioned that to me. I thought to switch to gracias in Spanish. Then I thought about merci because of Morocco, but then I say maybe in Arabic. What I mean, and this is something that Shamsat made very clear, is that we need an agreement and we need very basic solutions so we can speak the same language and in many different jurisdictions with different problems.
Thank you very much, Miguel. And what a nice way to conclude your presentation. I think we have around 5 to 10 minutes to take some questions from our audience. I think that we have already a first question, and it is directed to the whole panel, and it goes as follows. A large gap in sustainable infrastructure has been observed in recent years in Africa. What have been the major bottlenecks that have hindered this financing, and does the COVID-19 pandemic threaten to slow the expansion of investments in key clean energy technologies? So maybe Ottaviano can give us a little bit of perspective, since he spoke about Africa. And if any other speakers would like to intervene, please feel free.
Look, Rim, and we've been delving on this issue in the preparation of our notes for the T20. Clearly, the risk-adjusted returns of private projects in Africa are perceived by financial investors as less attractive than elsewhere in the world, especially in the past decade. And this is primarily due to two factors. One, the prevalence of market failures, and some Africa-specific factors. It doesn't help that you have this lack of trade integration in the region. The countries individually in Africa are more connected to countries elsewhere, to Europe, than among themselves. And this obviously goes against infrastructure projects that cut across borders and constitute a whole tissue. And this is particularly a problem given the smallness of many of the countries in the region. But a second factor as well, it has to do with poor project preparation, high exchange rate risks, and difficulties in divesting. The investors must, particularly financial investors, have to have the possibility, in order to have them in, you also have to give them the clear chance that they can liquidate their investments if they need the cash and so on. And that's how the private sector financing of the infrastructure works elsewhere. Africa had some experience in the 90s with the private sector participation. Some mistakes were done, and there are lessons to be taken from that. But the fact of the matter is that there is no option. The public finance will be facing strains in the region for many countries, and ways have to be found so as to have the complementary role to be played by the private sector. I want to take the chance and remark, Franco was very fortunate when he stressed the following. We're talking about private sector finance, but this is not a perfect substitute for the public sector investment, because to some extent you need the complementarity between the public and the private sector. But in order to have the private sector, and we need the private sector, you have to define the public sector participation in a way that brings in the private sector rather than pushes it out.
Thank you very much for your brief but very clear answer. We have another question. This one is directed to Dr. Shamshad. And very briefly, if you can describe how is the situation in Pakistan with regard to green recovery and green infrastructure investing in particular.
As I mentioned, in the developing countries, momentum is building, but it's very uneven, and both in terms of the quantity and the quality of the progress that is being made for green or sustainable infrastructure. But there are some signs that there will be a much more substantive shift towards it. Now, let me first talk about a few areas which stand out. I think the government has, as I mentioned, the greenhouse gas emissions of the power sector is high all across. So you have to really move from, say, coal or other fuel-based assets to renewable energy. And in Pakistan context, they have introduced a new renewable energy policy to be able to reach 20% mix or 30% by 2030. So that's a good development. However, when you look at the policy and legal regulatory framework, there are lots of good things about it, but there are few technical issues which are holding back the private investor. A second important example I'd like to, there's a lot going on other climate mitigation and adaptation front, but the big program of the Prime Minister is to have billion trees, which is internationally well recognized, and it's a big program of $1 billion of planting trees in the Northwest Frontier Province, but also all across the country. And as I have pointed out, that Pakistan, although it's not a big emitter itself, but Pakistan is very climate vulnerable, and it's about 7 in the scoring. So it's a very serious situation, and more international and regional cooperation and collaboration is needed to promote sustainable infrastructure. But the last point, which is related to Ottavanio's point, we have been working on the debt issues, where G20 has offered, of course, the DSSI, the Debt Service Suspension Initiative, and then followed by the Common Framework Agreement. Pakistan has been a beneficiary of the DSSI, but the problem lies for all the middle income, low income and middle income countries that have a higher share of private credit within their portfolio of debt. Eventually, something needs to be done about the Common Debt Framework Agreement to unleash resources for more investments into green and sustainable infrastructure, because as has been very well pointed out, that countries have faced economic contraction, revenues have contracted, and these revenues have by and large gone to finance the repayments, or even the debt relief that was provided by the bilaterals has gone for repayments. So I think moving forward, it would be very helpful if the emerging economies and developing countries are able to enjoy a proper benefit of a common debt framework agreement, which is still very restrictive and does not have the required elements which could help restructure the debt effectively, and countries are very hesitant to get into debt restructuring for fear of haircuts. So the point I'm trying to link is that we really need to find an effective mechanism to be able to get on board on it. But I think it's not an easy task to be able to move forward with the debt surge that is facing most of the developing countries. We can talk more about it in the interest of time. Let me stop here.
Thank you very much. Indeed, we're actually running out of time, so I'm turning very briefly to Franco and Miguel if they have any concluding words before we close this webinar. Franco, I think you're on mute, or Miguel, go ahead.
No, just saying thank you, Rim and Shamshad, Ottaviano, Franco. It was super interesting, and I think there's an agreement showing up, which I think is important for the challenges ahead.
Thank you very much.
Thank you. I also found this very, very interesting. I mean, one issue that perhaps I could propose for the next round is technological innovation, which is crucial for green and for the climate change. And we are always used to think at top-down technological coming from advanced economies, but maybe there's a lot also in the South that can be done to really improve maybe small-scale technological innovation that can do a lot for, and I have some knowledge of this, but I would like to have more from you if we have another chance to meet.
That's my favorite topic, Franco.
Okay, good.
Thank you. We will take that into considerations. I mean, it's a discussion that I know many people are having right now, and I hope we will continue to exchange on these issues beyond this webinar. So before concluding, I would like to take a minute to thank again all our speakers, Dr. Shamshad Akhtar, Ottaviano Canuto, Miguel Vasquez Martinez, and Franco Pasacantando. Thank you all very, very much.
Thank you.
Thank you.
Thank you.